computer. I will record. I am recording now. Hello. Welcome to chapter 4. I know we usually start 30 minutes ago, but thank you for being patient with me, guys. We are going to talk today about cash and internal controls. I promise you, this chapter is going to be so much easier from the other 3 chapters. It really is. Today, the primary thing we're going to focus on is how to prepare or reconcile a bank statement. It's going to be one of the big things we handle. We're also going to talk about internal controls and why we need internal controls. So, internal controls need to be in place to help protect the company and basically safeguard or protect their assets. Financial statements can have errors because of just accidents or because of a person intentionally deceiving another person or company for gain. Fraud can exist because there are 3 components that have to be in place for fraud to exist. One is there has to be an opportunity. That opportunity means the individual has the ability to steal or to defraud someone. Usually there is what we call a need, a motivation that entices someone to do that. You see this a lot with people with a lot of gambling debts. They have put themselves into a place where they, for whatever reason, need some help. And then oftentimes the person rationalizes this behavior. I had a situation like this happen in my office. I know better. I had a particular client, employee that I was very close with for 18 years, that I entrusted with my life, that my children saw as a second mother, that had an opportunity because I let her deposit the checks. So she had the ability, and she was alone a lot, to, she had the opportunity. She somehow had the motivation or the need, maybe because her husband was a drunk and was taking all their money. But she must have somehow rationalized it, like, Nancy's not going to miss that I do these tax returns behind her back, or they're, you know, I'm only taking 3 people's monies and not letting her know about it, or however she rationalized it. And it probably went on for a long time before I even caught it. But it happens because these 3 components are in place. And it can happen. I mean, the very time you think you couldn't do it or someone couldn't do it is the biggest warning sign, because it's scary how people, if they have the ability, that's why accountability is so important. So you just can't be put in a position to do anything wrong. Anyway, it was a huge lesson for me. I'm still upset about it. But you know, you learn your lessons and just go, no one's exempt from potentially doing wrong things, which is why we all need to have safeguards, security, controls in place. Now in my office, the only person I trust with the money is my husband, because you just don't allow a good employee to even be tempted. These internal controls you put in place, safeguards, help eliminate the opportunity element of fraud. That's the only one you can eliminate or try to eliminate. The motivation and the justification, you can't do anything about how people want to view it, but we can try to put a damper on the opportunity element. We do these to protect the company's assets and ultimately to help make sure that our financial statements are accurate. So there was a lot of this going on in the early 2000s. WorldCom, Enron, even in Minnesota, we had Petter's Warehouse, just a bunch of fraudulent activities that mainly happen with the people at the top. Usually it's the top executives because they have that opportunity to really suck money out of the company. Enron and WorldCom were just huge debacles. And because of how so many people lost jobs, retirement monies, I mean, their whole life's worth, Congress came out with an act called the Sarbanes-Oxley Act of 2002. Two men, Sarbanes and Oxley, created the SOX Act, we call it. It basically applied to companies that were public companies where their stock is traded, meaning they have to file financial statements with the Securities and Exchange Commission. So these guidelines, this Sarbanes-Oxley Act, basically set up new laws related to internal controls within a company and the relationship that auditors have with their clients. A big accounting firm called Arthur Andersen, which is no more because they were fraudulent along with the companies, were involved in these egregious acts. So the relationship between auditors and clients is important to state exactly what type of relationship can occur, what kind of transactions or business relationship they can have with the client. So there were all kinds of things, but the one thing we're going to focus on is internal controls. The company's management each year has to document and assess the effectiveness of their internal control processes and procedures. And the company's auditors have to express an opinion if they believe the management's internal controls they've put into place are effective. So this was a huge undertaking, caused a lot of ruckus, lots more expense in auditing. I can't tell you it necessarily helped the industry. Fraud still occurs, but it sure put more safeguards in place. So primarily through SOX, the piece we're going to focus on is the management of a company and the company's auditors have to each year document about the effectiveness of the company's internal controls. So, which of the following statements is not true about SOX? All companies do not fall under this guideline. It's saying that all companies do. Only public companies that are required to report to the Securities Exchange Commission are under these guidelines. So, with a company, every company has various internal control issues. The control environment really sets the ethical tone of the company as far as the policies and procedures that are put into place. Have you ever gone into some companies and just the control environment just feels snaky and it just feels like greedy, and the attitude of the management is just suck everyone dry, get what you can get? And then you can go into other companies and there's just an ethical value to the company and you feel it. And the leadership at the top is about being honorable. That's the control environment. And you see that mainly coming from the top. Then risk assessment is the next step, where it looks at the various risk factors the particular company could have. So it analyzes the various risks because of that company and looks at how they can put into place procedures to help eliminate those risks. A casino, what's the risk there? Lots of cash floating all around. Each company has its own risk assessment. I remember my daughter used to work at like a Foot Locker kind of place in the Mall of America. And they had internal controls in place. So the shoes from the back room didn't walk away. So they had cameras everywhere, and they had one person in the shoe room that could distribute the shoes. And I don't know how they kept track of the shoes that came back, but every place has a certain level of risk. And the goal then is to create activities, control activities in place that may include authorizations, who is authorized to perform certain transactions or acknowledge certain transactions, reconciliations, and separation of duties. So maybe the person who orders the supplies isn't the person that receives them at the dock. Then once those control activities are in place, you need to continually monitor these activities and see if they're being adhered to, if they're being followed, or if there are any issues regarding these control activities. So, what are some control activities that companies can handle? One is separation of duties. For a movie theater, the employee selling the movie ticket shouldn't be the one that accounts for the cash at the theater at the end of the night. Or how about with concession supplies? Those probably should be kept in a separate room so they just can't be removed from the building. Proper authorization, possibly the theater's management can be authorized to make purchases over $1,000 or $500. And then employees should know what the company's internal control procedures are, and if something goes wrong, how they have the means to help account for them or be able to discuss them. E-commerce controls, theaters should maintain and systematically check for firewall settings to prevent unauthorized access to accounts and credit card numbers. Now, a detective control. So these controls here are preventative. These help prevent issues from happening. Detective controls will help reveal if there are problems. Reconciliations, where management periodically determines whether the amount of physical assets of the company agree with the accounting records. Performance reviews would be that the amount of concessions sold should be compared to the number of tickets sold over a period of time. And then audits, where a company hires someone outside the company, independent people, to see if the internal control procedures are actually effective. Ultimately, the responsibilities for internal controls rely with the CEO and CFO of a company. Each year, they're required to sign a report personally, to personally guarantee the adequacy of those internal controls. Here's a first one let's look at, guys. If a company places cash receipts from the day in a safe or bank deposit box, this would be an example of a separation of duty, a physical control, a reconciliation, or a performance review. What do you think there? You just look to see how I'm doing here. Wouldn't that be a physical control, guys? It's protecting that cash and putting it away right away. This is a physical control. So guys, we're going to look here at this exercise, and we're going to see, are these true or are these not true? So the components of internal control are built on the foundation of the ethical tone set by management. Yeah, that's true. How about number 2? Once every 3 months, managers need to review operations to ensure that control procedures work effectively. How about more than once every 3 months? How about daily or weekly? I haven't told you about collusion, but collusion refers to the act of a single individual circumventing internal controls. Collusion is when 2 or more people circumvent internal controls. Detective control procedures are designed to detect errors or fraud that have already occurred, while preventative control procedures are designed to keep errors or fraud from occurring in the first place. What do you guys think about that one? Any ideas? True, false? It's true. Fraud committed by top-level employees is more difficult to detect because those employees more often have the ability to override internal control features. It's true, guys. You know what? They're making the rules. They kind of have more a leeway or ability to circumvent those guidelines. A good example of separation of duties would be having one person collect cash from customers and account for it while having another person order inventory and maintain control over it. No. A good example of separation of duties would have one person collect the cash and another person account for it, or having one person order inventory and another person maintain control over the inventory. Next, employee tips historically have been the most common means of detecting employee fraud. That is true, guys. That is a true statement. Detective controls include reconciling the physical assets of a company with the accounting records and comparing actual performance of individuals or processes against their expected performances. That's true. And then how about this last one, guys? I'm going to have you guys put in the chat box what you think here. Effective internal controls and ethical employees ensure a company's success. Do you think that's true? Put that in and let's see what you think. I saw true, 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 false, false. Guys, it's false. You know why? Because you need internal controls and ethical employees. That is great, but it sure doesn't ensure the success of a company. You need a good product. You need so many other things in place in order to have a good internal controls. Okay, what did I do now? Okay, there are limitations on internal controls. Effective internal controls can't turn a bad employee into a good one. Internal control systems are susceptible to collusion. They are, guys. If two people want to act together to circumvent controls, it's more likely to happen than just one person. Top level employees can override internal control procedures and ultimately then have the opportunity to commit fraud. But ultimately, guys, you can have great internal controls, you can have great employees, but it doesn't mean you're going to have a successful company. You need a lot more than just that. That's a good start, but you need a lot more. Everyone in the company has an impact on the operations and effectiveness of internal control. But who must take final responsibility? Anyone know? Who has to take final responsibility?
The top executives.
Exactly, the top executives. Excellent. So guys, we're going to look at this exercise. And for each scenario, we're going to look at what activity could have been violated. Control activities will include separation of duties, physical controls, proper authorization, employee management, reconciliations, performance reviews, and if there was no control activity violated, state none. Take a minute, guys. Let's give yourself 90 seconds. Try this, and then we'll go over them together, okay? Okay. Oops. Now, a manufacturing company compares total sales in the current year to those in the previous year, but does not compare the cost of production. Okay. So what would that be? Performance reviews, so that employees can have easy access to office supplies. A company keeps supplies in unlocked cabinets in multiple locations. That's a violation of physical controls. At the end of each day, a single employee collects all cash received from customers, records the total, and makes the deposit at the bank. That's a violation of separation of duties. The employee who's collecting the cash shouldn't be the one that records the totals and makes the deposit at the bank. At the end of the year only, the company compares its cash records to the bank's records of cash deposited and withdrawn during the year. They should have monthly reconciliations. A company encourages employees to call an anonymous hotline if they believe other employees are circumventing internal control features. There's nothing being violated here. That's really a good thing. It's unfortunate that we call them whistleblowers. I have so many issues. We're seeing that over and over again, but that's a good thing. All employees have the authority to refund a customer's money. Not good. There should only be certain people that have that authorization to do that. Okay, now, what's cash? Cash is a variety. It can be coins, checks, savings accounts, checking accounts, credit card sales, debit card sales, cash equivalents. All of those lump in to the total cash balance. Excuse me one sec. Okay. Which of the following would not be considered a cash equivalent? Wait, guys, which of these do you think would not be a cash equivalent? Cash equivalents are current assets. A certificate of deposit is not a current asset because that's a long-term asset. Since it doesn't mature until a year from now, it's not going to be considered a cash equivalent. Now, we're going to look at controls over cash receipts and cash disbursements. Some great ideas for controls over receipt of cash and checks is one person opens the mail each day and makes a list of the cash and the checks they received with the name and the amount. And then another employee deposits the cash and checks into the company's bank account each day, who's different from the one who received the cash and the checks. Then another person records the cash receipts into the accounting records and verifies the cash receipts with the bank's deposit slip. And it's a great idea to try to limit the cash using credit cards and debit cards and reduce the amount of cash employees handle. It's ideal. And you see that happening a lot, even like on airplanes. You can't buy something with cash anymore. You have to use a debit card or a credit card. The acceptance of credit cards provides an additional control by stopping employees needing to handle cash. Okay. Sarah Martinson raised her hand. Is there an issue, Sarah?
No, that was a long time ago.
Oh, I'm sorry, honey. Okay, so a movie theater accepts MasterCard as payment for $2,000 worth of movie tickets. And MasterCard charges the movie theater a service fee of 3%. The service fee equals $60 or 3% of the sales. So how we would record this, guys, is we would take the entire fee, the revenue, and we would show our revenue to be the $2,000. Even though we only get $1,940 of it, we're going to show the revenue to be $2,000, even though we will debit our cash of just $1,940, but we will show an expense, a service fee expense of $60 against the revenues, because we actually did sell $2,000 worth of movie tickets. And a cost of doing that business was the service fee expense on the credit cards. Just like credit cards, debit cards offer customers a way to purchase goods and services without a physical exchange of cash. They differ in that most debit cards, referred to as check cards, work like a check and withdraw funds directly from the cardholder's bank account at the time of use. Similar to credit cards, the use of debit cards by customers results in a fee being charged to the retailer. However, the fees charged for debit cards are typically much lower than those charged for credit cards. Okay. People get confused with the word debit card. Remember, we refer to an increase in cash as a debit to cash. If you use your debit card, it's going to result in a decrease to your cash account. So just don't get that confused. Sometimes we use these names and they get confusing on us. The term debit card refers to the bank's liability to the company being decreased when the company uses a debit card. Don't let it mess you up. Make all disbursements other than very small ones by check, debit card, or credit card. This provides a permanent record of all disbursements. Authorize all expenditures before purchase and verify the accuracy of the purchase itself. Just remember, who authorizes the payment shouldn't be the one who writes the check. And make sure all checks get serially numbered. Okay. Now, when a movie theater pays $1,000 to advertise its showtimes, that's when we would debit our advertising expense. And if we pay with cash, check, or credit card, we're still going to credit our cash. Record purchase of advertising with check, cash, check, or debit card, sorry, not credit card. If we use a credit card, the credit card is like an accounts payable. It doesn't get paid till we pay the bill. So if we use a credit card for advertising, then we will show it as advertising expense, and we would credit accounts payable if we are using this with a credit card. If we're using it with cash, check, or a debit card, we are going to show it as cash. Since cash is the asset of the company most susceptible to employee fraud, controls over cash receipts and disbursements are a significant part of the company's overall internal control system. So it's important that we have separation of duties regarding the handling of cash. And it's important that we try to use checks, credit cards, or debit cards as much as we can and receive those as much as we can and eliminate the cash piece. So remember, with cash controls, you can see this again. These are great controls over cash on both receipts and disbursements. So make sure you look at that. The big piece to this chapter is learning how to reconcile a bank statement. Now, the balance of cash in the company's records may not equal. Chances are it won't equal the balance of cash in the bank's records. It's not going to, because there's timing differences. The company's records are going to show checks that maybe haven't cleared the bank yet. And the bank records may show service fees or deposits like accounts receivable that the company is not aware of. So there can be errors on both ends, but oftentimes it's just timing differences why they don't match up perfectly. But when we record a when we create and prepare a bank reconciliation, it's going to match the balance of cash in the bank account with the balance of cash in the company's own records. So here you see a company's cash account records showing the receipts and the disbursements. And then we see a summary of the transactions. We start with the beginning balance, we add our receipts, we subtract our disbursements to get our ending balance. This shows a bank statement. It shows the name of the bank. It shows our deposits, our withdrawals, and lets us know our ending balance. Okay. The bank statement refers to a deposit in the cash balance as a credit and a decrease or withdrawal as a debit. This terminology is the opposite that's used in financial accounting. And remember, the reason it happens that way is your money or the company's money with the bank is a liability. That's why it's called a credit. Cash increase will be a credit to them because it is a liability. The money that gets deposited into an account for the bank is a liability. Think about the bank debits cash, credits the liability. Okay. So when we reconcile this bank account, we're going to first reconcile the bank's cash balance. Then we're going to reconcile the company's cash balance. So to reconcile the bank's cash balance, we're going to look at transactions that were recorded by the company, but haven't yet hit the bank. That's going to be deposits outstanding and checks outstanding and potentially bank errors. It happens. So you see here on the bank statement, and you see the company's records. Do you see that on March 5th, we showed sales of 3,600. They hit the bank on March 8th. Do you see on March 30th, we show a deposit of 8,500. But do you see that it hasn't cleared the bank yet? Do you also see on March 29th on the bank statement that there's a $2,000 deposit due to a note that the bank received, along with $200 in interest? But can you see that the company has not recorded that in their books yet. So there's differences that are happening here that we want to take into account. So in this scenario, we pretty much match up those 5 deposits. But the last deposit in the books have not yet hit the bank statement. We also see the company's records, and we see the bank's records of disbursements. Do you see the salaries match up? The rent matches up, but the advertising's off. The company reported $3,000 in advertising with a debit card, and yet the bank shows $3,300. So upon looking at this, it looks like the company made an error of $300. That should have been $3,300. Then we show supplies that matches up, and repairs. But we have a check for insurance of $5,400 that doesn't look like it hit the bank yet. And as far as the bank statement goes, we have a $4,100 electronic funds transfer that doesn't look like we show it in the books. We've got an NSF of $2,800 of non-sufficient funds that we deposited money from a customer. We deposited it, and yet when the bank went to fulfill that through the customer's bank, it must not have had enough money. Therefore, we're getting it sent back to us. And it also looks like we have a service fee of $100. So the first thing we're going to do is we're going to show the bank's balance and the company's balance. We're going to look at the bank's balance and add the deposits that have been outstanding. And then we're also going to, on the bank side, show the checks that are outstanding to come up with a bank balance per reconciliation. Then on the company side, we'll show the items that hit the bank, but the company was not aware of. The note received, the interest earned from the note, the electronic funds transfer for utilities that we didn't show, the NSF from a customer, the service fee, and the corrected advertising expense. So you see, we start with the balances on each, the bank side and the company side. Once we create our transactions to balance, do you see at the end, our bank balance per reconciliation is $29,500, and the company balance per reconciliation is also $29,500. Okay. We've reconciled. Sometimes students think an NSF check from a customer as a bad check written by the company instead of one that was written to the company. When an NSF check occurs, the company has deposited a customer's check, but the customer did not have enough funds to cover the check. The company then has to adjust its balance of cash downward to reverse the increase in cash it recorded at the time of the deposit. Ultimately, when a customer creates a bounced check, it's going to now create a receivable for the company until the customer honors the funds it owes. So what do you think here? Which of the following items would be found on the bank side or the left side of the bank reconciliation? Anyone?
Would it be B?
A B? B. And Would an NSF check from a customer be treated on a bank how would an NSF check from a customer be treated on a bank reconciliation? Wouldn't we subtract it on the company side? Okay. Now, we're going to then talk about anything that has occurred on the company side. We then need to show as journal entries. We don't care about anything on the bank side, but if we make an adjustment on the company side, we need to show those journal entries. So when we finally received a note with the interest, we want to report that because we're no longer due that note receivable. The expenses that hit the bank that we weren't aware of, we want to show that 4,100 in utility bills. The NSF, we need to show that that company who we thought had paid their bill, since it was NSF, we need to then debit our accounts receivable. We need to debit our service fee expense and our advertising expense. Okay. So this right here, guys, is so key. Just give me a minute. I want you to write this one down. This, guys, oh my gosh, is key to what you need to do for recording or reconciling a bank. You start with the bank's cash balance. You add deposits outstanding, you subtract checks outstanding. Plus or minus any bank errors, you have an ending balance. Then you have the company's cash balance. You add any notes possibly received by the bank or interest. Subtract any payments that we didn't have but got handled through the bank. Subtract any NSFs and bank service fees, plus or minus any company errors. So guys, the best way to do this is to go through problems. So here is exercise 4.9. Spielberg Company's general ledger shows a checking account balance of $22,970 on July 31st, 2018. The July cash receipts of $1,855 included in the general ledger balance are placed in the night depository at the bank on July 31st and processed by the bank on August 1st. The bank statement dated July 31st shows bank service fees of $55. The bank processes all checks written by the company on July 31st and lists them on the bank statement except for one check totaling $1,460. The bank statement shows a balance of $22,490 on July 31st. Prepare a bank reconciliation to calculate the correct ending balance of cash on July 31st, 2018. So guys, take 2 minutes here. See if you can look through this and figure out how you want to handle it, okay? Give you 2 minutes while I figure out what's wrong with my computer. You guys need a little more time?
Yes, just a couple more minutes.
Thank you. Yes. Okay. So the first thing we're going to do is show the bank balance on the bank balance side and show the book balance on the book balance side. And it gives us both of those. It says at the top here, the checking account balance is $22,970, and then it says farther down, the bank balance shows $22,490. The next thing we're going to do, oopsie. The next thing we're going to do is show what has been outstanding, deposits and outstanding disbursements. So we are going to show here, sorry, we know that is right, the deposits and checks outstanding. So as you see, did I just screw this up again? That all happened again. Okay, here we go. So what we're going to do then is the deposits outstanding. It says that in the July cash receipts of $1,885 included in the general ledger balance are placed in the night depository at the bank on July 31st and processed by the bank on August 1st. So they are outstanding on the bank side. So the first thing we're going to do is show those deposits outstanding of $1,885. Then it tells us there is a check. The bank processes all checks written by the company and lists them on the bank statement, except for one, a check totaling $1,460. That is a disbursement or check that's outstanding. So we're going to show that also on the bank side because that hit the books, but it hasn't hit the bank yet. Then we're going to look at things that have possibly affected the bank balance, but hasn't been put on the book side. There's only one. It says the bank statement dated July 31st shows bank service fees of $55. So we're going to show on the company side those bank service fees of $55. Do you see that if we show the banks on the bank balance, the deposits outstanding added, the disbursements outstanding subtract, and then the service fees on the company side, do you see how we balance? Do you see that our bank balance per reconciliation is $22,915? And our company balance per reconciliation is also $22,915. There's only one journal entry we're going to need to report here. We only report those items that affected the company's balance. The service fee expense, because we need our books to be updated. So the service fee expense of $55, and we credit our cash for $55 is the journal entry we need to make on behalf of this. Okay, let's look at another one. This one says on October 31st, Damon Company's general ledger shows a checking account balance of $83.97. The company's cash receipts for the month total $74,320, of which $71,295 has been deposited in the bank. In addition, the company has written checks for $72,467, of which $70,982 has been processed by the bank. The bank statement reveals an ending balance of $11,727 and includes the following items not yet recorded by Damon: bank service fees of $150, notes receivable collected by the bank of $5,000, and interest earned on the account balance plus from the note of $320. After closer inspection, Damon realizes that the bank incorrectly charged the company's account $300 for an automatic withdrawal that should have been charged to another customer's account. The bank agrees. Prepare a bank reconciliation to calculate the correct ending balance of cash on October 31st, 2022. So guys, I'm going to give you about 4 or 5 minutes here to attempt this. Then we're going to go through it. I do that so you can kind of see where your strengths are. And then we'll go through it, okay? See you in a minute. Jeannie, I'm going to run to the restroom. Oh. My computer's finally working. And your address and your phone number and everything, and email is all okay. With the portal or with the Intuit? Intuit is put in or? Oh, okay, okay, yeah. Okay. Oh, wonderful. Okay, guys. Got my computer to finally work. Okay. Oh, shoot. So for this one, we're going to start with the balances. We're going to start with the checking account balance. On the bank is $11,727. The company's balance we're going to show at $8,397. The next thing we do is we look for any deposits outstanding and any checks outstanding. So we see the company's cash receipts total $74,320, of which $71,295 has been deposited in the bank. So the difference of $3,025 showed the deposits outstanding, which we add to the bank side. Then it tells us the company's written checks of $72,467, of which $70,982 has been processed by the bank. So the difference there of $1,485 have not gone through the bank. So we are going to show that again on the bank side. It said here, Damon realizes the bank incorrectly charged the company's account $300 for an automatic withdrawal that should have been charged to another company. So we're going to show that bank error here. We don't need to do any journal entries because it's not on the company side. This is the bank. They are going to correct it to show our bank balance per reconciliation now is $13,567. Then on the company side, we will show things that have happened at the bank we have not yet recorded. So it shows that they collected a note receivable by the bank of $5,000 and interest earned on the account plus from the note of $320. So those are both items that the bank shows that the company has not yet recorded. So we will add the note received. We will add the interest earned. And then we also see that the bank took out service fees of $150. So we will subtract the service fees of $150. So we have the company balance of $13,567, and it matches the bank's balance of $567. Okay, Sarah, are you raising your hand? Do you have a question? Because you can just butt in.
No, I don't. That's still there from the beginning. I think you have to take it down somehow.
I'm sorry, sweetheart. Okay, I lowered your hand, Sarah. Sorry about that. Okay, guys. So lastly, the only thing we need to show journal entries for is to show the note received, the interest earned, and the service fees. We only show that piece from the company. So we debit our cash of $53.20. We credit our note receivable of $5,000. We credit our interest revenue of $320. Then we show our service fee expense of $150, and we credit our cash of $150. Okay. Next, employee purchases. This is pretty straightforward, but most people have a petty cash fund just so they keep small amounts of cash on hand for different purchases. Usually when we're dealing with the petty cash, we're just going to talk just a couple journal entries regarding establishing the fund and replenishing the fund and recording the expenses. Also, there are other things that may occur, such as debit cards and credit cards that are issued by the company that people will use, and how we go about recording those. So to establish a petty cash fund, we debit our petty cash and we credit our cash. Okay, then throughout the time, we've got various transactions going on with the petty cash fund. We show items of the different managers using their credit card. So as you see, whenever they use their credit cards, they're going to always show an accounts payable. The petty cash, when we use that and it reduces, we will credit our petty cash. Okay. So you see here our lunch, we call it an entertainment expense of 60, the delivery expense of 90. That was a credit to petty cash of 150. For the credit cards, the supplies of 1,400, the advertising of 1,500, and the postage of 1,200 will be credited to accounts payable for 4,100. To replenish the petty cash fund to keep it at a certain balance, we just debit the petty cash and we credit our cash. Okay? Pretty straightforward. As far as the statement of cash flows go, we know we report our cash on the balance sheet, and we also will report it on the statement of cash flows. We know we break down the statement of cash flows into 3 different activities: operating activities, investing activities, and financing activities. Now, guys, the reason a company's in business is really why they're in operation. So cash transactions affecting revenues and expenses, receiving money from customers and then paying for the expenses are all operating why the company's in business. Investing are the purchase and sell of long-term assets. Purchasing and selling land, purchasing and selling equipment, purchasing and selling investments, only for cash. Financing is borrowing money from a bank, paying the money back to the bank, or anything involving stock, owner's investment. That would be the financing piece. So these various transactions we can look at and say, hey, what kind of transaction is it? Financing, investing, or operating? If cash is involved, then we put it on the statement of cash flows. If cash is not involved, we don't put it on the statement of cash flows. So you see 2 times purchase supplies on account for $23,000. That did not involve cash. They purchased supplies on account. Therefore, since cash was not involved, we are not going to put that on the statement of cash flows. And when we provide soccer training to customers on account for 20, they owe us that money, accounts receivable. We will receive that money from the customer. Cash wasn't involved, so we will not show those 2. So the statement of cash flows involving those transactions. The inflows came from customers in number 6 and 8. Number 6 and number 8. The outflows involve salaries and rent. Purchasing equipment shows in investing. And then the financing activities are 1, 2, and 10. Again, remember, if it doesn't involve cash, we don't show it on the statement of cash flows. Which of the following items would be categorized as an investing activity on the statement of cash flows? We borrowed money from the local bank by signing a note to repay the full amount 2 years later. We paid for supplies in cash. We paid for the purchase of equipment using cash, or paid salaries to employees. What do you think, guys?
I think it's C.
Awesome. It is C, because purchasing equipment, the purchase and sale of long-term assets, would be investing. Now, for the next cash and cash equivalent ratios, for the next couple weeks, we're going to start showing ratios. Now, the ratios I'm not necessarily going to talk about, although you might see them on a test. This one really doesn't show much in ratio, so I'm not going to worry about that. What I would like to do now is, because I finally have my computer back, it must have cooled down. I'm going to stop this recording, and I am going to go over the homework and the quiz for you. And are there any questions before I stop the recording? Okay. So this covers chapter 4.